Imagine you're trying to make your portfolio safer. Stocks feel risky, so you buy a bond ETF. A few months later, interest rates rise, the ETF drops in value, and suddenly you're wondering, wait, aren't bonds supposed to be safe? That confusion exists because most people understand bonds from the outside, but not from the inside. And today, we're going inside exactly how a bond ETF is an exchange-traded fund, a basket of investments that trades on a stock exchange just like a stock. Instead of holding shares of companies, it holds bonds. But here's the key question. If bonds eventually mature and pay investors back, why can a bond ETF lose money and never seem to mature at all? A bond ETF is not a bond. A bond is a loan. You lend money to a government or company, and if everything goes according to plan, you receive interest payments plus your principal back at maturity. A bond ETF owns many bonds, but the ETF itself usually never matures. It constantly replaces old bonds with new ones. That's the misunderstanding that catches many investors off guard. If you enjoy learning how money actually moves behind the scenes, consider subscribing. And here's a question for you. If individual bonds eventually return principal, why would anyone choose a bond ETF instead? Hold that thought. Basic mechanics. Picture thousands of bonds flowing through a giant financial machine. Investors buy shares of a bond ETF. The ETF manager uses that money to purchase a large collection of bonds, government bonds, corporate bonds, municipal bonds, or a mixture of all three. Instead of owning one bond, you own a tiny piece of hundreds or even thousands. Layer 1 is what you see, one ETF share in your brokerage account. Layer 2 is what's happening underneath, thousands of interest payments, bond purchases, bond sales, and maturity replacements occurring continuously. Now, let's go inside. Here's where the system becomes interesting. Suppose a bond ETF focuses on bonds with maturities between 5 and 10 years. As bonds age and move below the 5-year range, the ETF may sell them and purchase newer bonds to maintain its target profile. In other words, the ETF isn't trying to hold bonds until maturity. It's trying to maintain a specific bond exposure. That's why the ETF behaves differently from an individual bond. You invest $1 into a bond ETF. The ETF combines your dollar with millions from other investors. That money purchases bonds from governments or corporations. Those bonds generate coupon payments, regular interest payments made to bondholders. The ETF collects those payments and distributes income to investors. But another force is constantly at work: interest rates. When interest rates rise, newly issued bonds become more attractive. Older bonds with lower yields become less valuable. As a result, the market value of the ETF's holdings falls. Surprising fact number 1, even U.S. Treasury bond ETFs can decline significantly when rates rise. Fact number 2, some bond funds lost double-digit percentages during recent rate hiking cycles. Fact number 3, bond prices and interest rates generally move in opposite directions. Fact number 4, many investors own bond funds without realizing they can experience stock-like volatility during certain periods. Fact number 5, diversification inside a bond ETF can reduce company-specific risk but cannot eliminate interest rate risk. 3 major components drive bond ETFs. First, yield, the income generated by the bonds. Second, duration, a measure of interest rate sensitivity. Longer duration funds typically react more strongly to rate changes. Third, liquidity, how easily assets can be bought and sold. Bond ETFs often provide liquidity that individual bonds may lack. Selling one ETF share is usually much easier than selling dozens of individual bonds. Not all bond ETFs are the same. Government bond ETFs focus on sovereign debt. Corporate bond ETFs focus on business borrowing. High-yield bond ETFs contain riskier bonds with potentially higher income. Short-term bond ETFs generally experience smaller interest rate swings than long-term bond ETFs. Many investors choose bond ETFs because building a diversified bond portfolio individually can require enormous amounts of capital. A single ETF can provide instant diversification, professional management, and easy trading. The invisible force isn't just interest, it's efficiency. You're buying access to an entire bond market through one click. Bond ETFs are not magic safety machines. They can lose value when rates rise. Credit risk, the risk that imagine you're trying to make your borrowers fail to pay, can affect certain funds. Liquidity can become stressed during market turmoil. Most importantly, unlike an individual bond held to maturity, many bond ETFs never naturally return a fixed principal amount on a specific date. Bond ETFs emerged because investors wanted bond market access with the convenience of stock trading. Instead of buying and managing dozens of bonds, investors could purchase one fund and gain broad exposure instantly. Today, the bond ETF market continues expanding. Investors now have access to specialized funds targeting maturity ranges, inflation protection, corporate sectors, and income strategies. So, when should you actually use bond ETFs? They're excellent when you want diversification, simplicity, liquidity, and broad bond market exposure. But if your goal is receiving a specific amount of principal on a specific future date, individual bonds may better match that objective. Understanding that difference can completely change how you think about safe investments. If you learned something new, like, subscribe, and share this video. And tell us in the comments, do you prefer bond ETFs or individual bonds?